Hi, welcome to Let's Talk Forex with Alison and Chris. In this episode, we discuss 3 of the most important technical indicators for short-term trading. If you aren't familiar with technical indicators, we have some links to specific videos and podcast episodes in the show notes. If you have any questions, please reach out to us on our social media channels or alternatively contact us at podcast@fxscouts.com.
Hey, Alison.
Hey, Chris. How are you doing?
I am ill, Alison.
I can hear.
I'm ill and I'm grumpy.
Oh.
But, no, I'm not that grumpy. I'm okay. I'm all right. How are you doing?
Yeah, I'm good. I'm enjoying the last of, well, not the last, but I'm enjoying some summer days here. Yeah, the weather's been beautiful, so very grateful. Had a lot of beach time this weekend.
Good for you.
Yeah.
That's fantastic.
What's it like that side?
Yeah, it's nice, actually. Portugal, in the winter when it's not raining is really nice. It's been like 20 degrees and sunny. Yeah, no, it's been good. So I've been out and about a bit, which is nice. But it is supposed to start raining imminently again. We get these big storms that roll in off the Atlantic in the winter, and then it rains for about 5 days solid.
Yeah, like torrential rain.
Yeah, exactly. So something to look forward to this week. Anyway, let's. What we're talking about this week? We are talking about technical indicators for short-term trading strategies, like we do in Forex trading.
Yeah.
I think something a lot of beginners are very wary of, technical indicators. In Forex trading, a lot of people don't understand it, so we thought we'd just give a brief primer. So technical indicators are important because, most successful traders who've done well in Forex trading or other financial markets, they're successful because they understand that markets are cyclical. And this means that what has happened before is probably going to happen again. So, and technical indicators are essential in helping traders identify these cycles. But especially when you're starting out, selecting the best technical indicator, it's not really very straightforward. Many traders make the mistake of relying too heavily on technical indicators without looking at the bigger picture, and this is very common. They use so many that they generate conflicting signals instead.
Yeah, it is. It's a big mistake that many, especially beginner trader make. And it's essential to learn how to use the right technical indicators based on your trading style, of course, on your objectives and then on your risk tolerance. But when you use them correctly, they're often a very valuable part of a trading strategy, and many traders rely on technical indicators.
Mm-hmm.
So if you're new to trading, you may not know what a technical indicator is, and they're basically mathematical equations that use price data, and this includes the opening price, the closing price, the price highs, and the price lows. And they're often displayed either on top of the price, known as overlays, or you can find them beneath the candlestick chart, known as underlays. And of course, that depends on which technical indicator you're using as to how it displays on your chart.
Yeah, and they can be used to short-term trading in any market. They can help us clearly see the price action. They can help you see whether the market is trending. They can show you volatility, whether a market is overbought or oversold. And they're really good for producing buy and sell signals. Particularly, they're good for signal generation, as I said, so they can generate buying and selling signals based on historical data. For instance, moving averages, they can indicate a possible trend reversal. So this is obviously a good time to enter or exit a trade. They're also really good for confirmation. This is, when you suspect that might be a good time to enter a market or exit a market. Technical indicators are very good for confirming your ideas. And they're also, particularly in confirmation, traders will use multiple indicators to confirm any particular market movement. They're also fantastic for risk management. For example, you can set stop losses based on support and resistance levels, and you'd identify those support and resistance levels using technical indicators.
Yeah, exactly. Yeah, they're very, very useful. And then you get, so for the purpose of this podcast, we've chosen 3 different types of indicators that we find the most useful for short-term trading. And the main functions of the indicators is to basically help you with trend identification, momentum, and volatility. And the following list includes some of the most popular indicators for day trading on short time frames. I hope this is helpful.
Yep. So first, we're going to talk about moving averages. They're probably the most commonly used indicator. They're used by both long-term positional traders as well as short-term traders to make trading decisions. So they should be used in the majority of your trades. So what is it? Well, anyone who's looked at a price chart will know that prices fluctuate wildly, or they're all over the place. The moving average smooths out this price action by taking the average price over a rolling number of periods. So the result is a smooth line that tracks behind the candlesticks and is overlaid on your chart.
Exactly. So in order to use moving averages, you'll see that the smooth line makes it easier to determine the trend of the market. So you'll see whether the price action is above or below the moving average. And if the line is sloping up, then the trend is up. And if the line is sloping down, then the trend is down. Or if the price action is above the line, it means it's generally an uptrend. Or if the price action is below the line, you could confirm that you're in a downtrend. And they also provide trade signals when the price crosses the moving average. So if you have a crossover, you could also assume that there might be a change in direction. Or when a shorter term moving average crosses over the long term moving average, you could also, it could be an indication that there could be a trend reversal, or likely because it's a lagging indicator, the trend has already reversed in direction. Mm-hmm. And they're very good for short-term trading because they're designed for trend following. So simple moving averages and exponential moving averages, as I said, they're lagging. So it means that the price will move first and then the indicator will react to that change. And the benefit is that they smooth out the market noise. But, as I mentioned, the downside is that they can be slow to show that the trend has changed. At those different turning points. So you'll notice you'll either have a crossover or a price moving above or below the moving average, slightly after the trend has already changed in direction. And even though this might seem a disadvantage, in many cases, it's as you mentioned earlier, Chris, it'll be a confirmation. And even though traders might lose out on a bit of the profit taking, it's still better than reacting too quickly and possibly acting or taking a trade in the wrong direction.
Mm-hmm. Yeah. And popular settings for long-term traders, they include the 50-period moving average or the 200 period. But indicators will adjust according to the time frame you're trading. On a daily chart, the 200 period moving average will represent 200 days. But if you're doing short-term trading, if you're looking at hourlies, then the 200 period moving average will represent 200 hours. So yeah, nice and easy. Also want to talk about another indicator, the relative strength index, the RSI. It's also used frequently on many traders' charts. It's an oscillator, which means that it displays as an underlay indicator. So it'll be underneath your candlestick chart, and it fluctuates between readings of 0 to 100. The math behind this indicator is what it does. It compares the size of up moves versus the size of down moves in price. So the idea is it compares the relative strength of the bulls in whatever market you're trading versus the bears.
Yeah, and it's most commonly used for finding overbought and oversold conditions, meaning that the price might have moved too far too quickly and could be about to reverse, or could be sort of about to, what's the word? It'll come back to its mean. Mm-hmm. Where the bulls have sort of overshot the mark where it should be, the price then will reverse either slightly or go in the opposite direction. And traders will compare the swings in the RSI with swings in the price to find divergence between the two. This is another way that traders use the RSI. And it's another signal to show that the current price might be about to reverse.
Yeah, and it's really good for short-term trading because in short time frames, price can change direction very quickly. And momentum indicators like the RSI are a leading indicator, which means that the RSI will often change direction before the price. And this can give traders an early warning signal to exit a trade before the price reverses. The drawback here is that the RSI can and does frequently display false signals, suggesting there's going to be a change in the trend when there won't be.
Yeah, that is something to be aware of. Often, especially in a trading market, the price might look like it's in a bullish market may look like it's oversold, but that oversold condition could continue. Especially if traders are reacting to certain news events or geopolitical events, so it's something to just be aware of when using the RSI. And the default setting for RSI is 14 periods. This means that it compares the current price to the last 14 periods, depending on whether you're using days or hours, to determine whether the price is overbought or oversold. And if you're looking at the daily chart, as I mentioned, you'll compare it to the last 14 days. If you're looking at the minute chart, it'll be compared to the last 14 minutes, etc. So it's a very useful indicator, the RSI, and most traders use it. And because most traders use it, you can also be sure that many traders will be seeing the same signals as you and therefore be reacting the same as you likely would in those conditions.
Yeah, exactly. And another one we want to talk about here, it's slightly more complex, is called the average true range, or the ATR. This can be written as a single number or is presented on the chart as an underlay, and it tracks how the figure has changed over time. So the ATR shows the average number of points a market has moved over a certain time period. The typical setting is 14, meaning it measures the movement over 14 periods. What it does, it's measuring volatility in the market, how much the price of a market has moved over that certain period of time. This is really useful information for short-term traders who are trying to decide particularly where to place stop loss and take profit orders.
Exactly. And a very common approach is to set your stop loss a certain multiple of the ATR away from the entry point. So if you're entering a long position, you might set your stop loss 1.5 times the ATR below your entry price. This means that because your stop loss is outside that average true range for that period, it's unlikely that your stop will get hit prematurely. And the take profit can also be set as a multiple of the ATR above the entry point for long positions, or obviously below for short positions. And the multiplier used depends on the traders, on your risk tolerance, and the volatility of the asset that you're trading. For instance, a take profit could be set at 2 times the average true range above the entry price for a long position. It very much depends on what you're trading and how much risk you're willing to take.
Yep. Yeah, and it's particularly good. It's because as a short-term trader, it can be tempting to get drawn into longer-term trades, as prices move up and down. And the ATR can really serve as a benchmark for where to set short-term profit targets and your short-term stop losses. Like with the other indicators we've discussed here, the trading platform will adjust your time frame settings to lower time frames to adjust for short-term trading. So a trader can use a 14-hour ATR instead of a 14-day ATR for more accurate information on short-term volatility.
Yeah. So choosing the right indicator for your trading strategy is critical, obviously, and the best indicator for you will largely depend on your trading style and your risk tolerance and the type of market you're trading in. Certain indicators work better in different market conditions. So trend indicators like moving averages are useful, obviously, in trending markets, while oscillators like the RSI are more useful in range-bound markets. So it's important to understand which indicators are used for which types of markets.
Yeah, and you also got to think about complexity here as well. Some technical indicators, as we discussed above, are like the ATR, are more complex than others, and they require a deeper understanding of technical analysis. So make sure that whatever indicator you do use, or indicators that you use, that you understand. You understand it fully and that you can apply it effectively. So yeah, finally, you need to discuss some of the common mistakes made when using technical indicators. The first one is over-reliance. Indicators are just tools, and they should not be the only fact considered when making trading decisions. Fundamental analysis, as you mentioned just now, geopolitical events, etc., and market sentiment should always be considered as well in whatever market you're trading.
Yeah, and the other mistake that many traders make is that they use too many indicators. And this leads to confusion, and it can also lead to contradicting signals. So it's better to master just a few indicators. And that's why we've only mentioned the 3 that cover trends, momentum, and volatility in this podcast. And another thing that many traders do is they misinterpret the signals. So sometimes indicators give false or conflicting signals, like I was talking about the RSI being overbought in a trending market. So it's crucial to understand the ins and outs of the indicators, and to understand what's happening on a broader level in the markets. So I think that about covers it.
Yeah, I think so. It's a bit of a prime move to technical indicators. I hope you guys have found it helpful. Yeah, what are we talking about next week, Alison? We don't know what we're talking about next week.
We don't know
what we're talking about next week. I think there's a few options. I'm sure we'll.
I think we're talking about TradingView next week, Chris. That was.
Yeah, that's right. We'll be talking about TradingView.
Yeah.
Which is becoming increasingly popular as a trading platform.
Yeah.
So we just wanted to have a deep dive into it for people who might be thinking about switching. Okay. Superb.
Yeah.
I'll speak to you then, Alison.
Yeah, and just a note that we're going to put some links to videos and previous podcasts about those indicators that we've mentioned in the show notes. So if you are interested and you want to understand a bit more about these indicators, you can go check out those videos.
Superb. Speak to you next week, Alice.
Cool. Cheers, Chris.
Bye.